What I have for you today is a short French case about the Italian luxury brand Ferragamo. It is from 2022, and here in the background you see the new store of Ferragamo in Paris, and these stores are just absolutely beautiful when one sees them inside. So let's see what went on here. We have a decision from the French Supreme Court from 23 November 2020, and in that decision the court basically annulled the previous court's decisions which let the taxpayer won, and they said no, the case must be referred, and the new court must review the previous court decisions, and so it went to the second chambre of the district court of Paris, and the decision, as you can see, is from 30 June 2022. You can also see here the court is called the second bedroom, and this is part of what terrifies me about Google translation from French to English, is that it's not always very accurate. Obviously it's meant the second chamber of that court. So let us have a look at the facts. We have Italy and Holland and France, and Ferragamo Spa in Italy as the ultimate parent. It had a Dutch intermediate holding company, and Ferragamo France, the taxpayer in this case, took care of distribution for Ferragamo Spa, which sold goods to France at a 25% discount of, I believe, the retail price. So just a small part of the timeline, from 1996 to 2009, Ferragamo France was loss-making. That is quite a long period to be loss-making. 2009 to 2010 were the tax years that got adjusted, even though I think more years were subject to audit. 2010 to 15, Ferragamo France was profit-making. I don't know what happened after 15. 2017 was the first Paris Administrative Court case in which it annulled the adjustment of the French tax authorities, and that annulment stayed on appeal to the Court of Appeal, and then from there the French authorities appealed to the French Supreme Court, and that was the decisions we saw here before. A 10-second commercial. If you want to learn more about international taxation or transfer pricing, or treat yourself to an all-round update, or if you want your team to learn or stay updated, please visit my online courses. So if we look at the French Supreme Court decision, now again, Google Translate makes things almost impossible to read, and it of course doesn't help that the French Supreme Court use extremely long sentences. But if we abbreviate it and correct it, then the sentence says the auditor has shown that the amount of salaries and external charges borne by Ferragamo France from 2005 to 2010, in particular due to the use of qualified sales staff and the rental of prestigious commercial premises, so these were higher, I think, it says was significantly higher than that shown by 19 comparable companies exercising the same activity of distribution of luxury products, but in an independent manner, without this additional expense being fully offset by the additional gross margin which the French subsidiary benefited compared to these companies, being in particular this 25% discount granted by the Italian company on the purchase of the Salvador Ferragamo brand products, right? So the French company had a couple of benefits. One, it didn't have to pay for using the name, which I think is always a confusing issue, because some distributors do have to and some don't. There's not really standard practices as far as that's concerned. Two, Ferragamo France could always return whatever it couldn't sell and get back the money for whatever it paid for that to Ferragamo Spa. And then three, there was this discount, right? And in spite of all of this, it was still loss-making, as we saw from 1999 till 2010. And what I find interesting is we don't hear much about the 25% discount, the benchmarks for that. I don't know if that's been discussed in the lower court cases, or whether the issue was simply that it's a typical transaction which only happened between intra-group companies, and therefore it was not possible benchmark it, because the 25% really wasn't only for distribution, it was in effect for running Ferragamo's flagship store in Paris, and obviously that had to be far more beautiful, and the staff had to be far more qualified, and everything had to be far more tip-top than in just an ordinary quote-unquote Ferragamo store. And then the Supreme Court goes on to say, it notes in the bottom of the top text that the company has been continuously loss-making from 1996 till 2009. And then it says in point 4, taking the view that the administration did not establish the existence of an advantage on the ground that the results from 2010 to 2015 had been profitable without any change in the transfer pricing policy, even though it had noted that the exposure of additional wage and rent charges was intended to increase the value of rebrands, did not yet have the because the Ferragamo did not have same reputation as the direct competitors had, the administrative appeal court erred in law. In other words, the court was wrong to say that because you made profits from 2010 to 15 without anything changing from a TP point of view, and therefore this was an arm's length policy, that was wrong, because I guess the 96 to 2010 was simply too long a period to be loss making, right? And then it says, in addition, the court distorted the facts and documents in a file by ruling out the existence of an indirect transfer of profits by merely relying on the profit situation from 2010 to 15, and the court incorrectly classified the facts of the case. Right. So this really is this issue of if you follow this part that eventually the company does become profitable. Does that make sense? And then the Supreme Court decides, one, the judgment of the Administrative Court of Appeal of Paris is to be annulled, and two, the case is referred to the Administrative Court of Appeal of Paris. So the same court. And let's see what happens there. First of all, the reference court talks about brand building. It brings up into a number of interesting points. It says, first of all, the verifier, it means the auditor, again, bad translation from Google, found that the average rate of charges over the period 2005 to 2010 was 62% for an average gross margin of 55%. So I think what it says here is, that on average, Ferragamo France was around 12% loss making on turnover, right? And that the external charges alone absorbed more than half of the commercial margin granted to Ferragamo. So even before it started paying for the goods that it sold, which was expensive, it already blew half of its commercial margin. And that is understandable, because if you look at these super luxury brands, for them, buying is not just buying. The consumer is supposed to have supposed to buy an experience, right? They're supposed to buy the most luxurious of the most luxurious, and that obviously costs money. And the reference court goes on to say the auditor, selecting 19 undertakings, 16 of which were proposed by the company, found that the rate of external wages of costs of Ferragamo France was much higher than the ratio and between the result of the operation and turnover of these companies were positive, right? So first of all, Ferragamo was loss making because its cost was 62% and its margin 55%, and these companies on our end, they did not have these extreme wage costs and other external costs, and therefore their results were positive. and it being the auditor concluded that the branding function assumed by Ferragamo France, thanks to its positioning in the prestigious locations and particularly qualified staff, was insufficiently taken into account by the group by not allowing the French subsidiary to cover its costs and generate profits by the sole application of the 25% discount, the return of unsold goods, and the absence of payments of royalties. So you can get the 25% discount and the free return of goods and no royalties, but still, if you don't make profit, then there is a problem with the comparability, right? And point 6. The court goes on to say it is common ground that the commercial policy pursued by the group involves to operate boutiques at prestigious addresses with highly qualified sales staff and in a sufficient number to meet the requirements of high-end clientele. In other words, no customer should ever have to wait for service. There should be at least 2 people waiting to serve you, right? The administration thus demonstrates that Ferragamo France assumes a function of promoting the trademark and that function is insufficiently remunerated. Ferragamo France is not justified in maintaining that its deficits were justified by the exercise of its activity in an investment phase, the development of a distribution network, and the increase in its net asset value. So Ferragamo France effectively says we had a long-term view, long-term plan, and there are a couple of interesting points here. The one is, if you remember the LG Electronics case in India, where the Indian court was very particular and said, the gain on one transaction can never offset the loss of another intercompany transaction. Each transaction by itself must be at arm's length. And I think the court here argues the same thing and says, we can't look at the long-term gain on all these things. You should have been compensated properly for the intangibles, the marketing that you were building for Ferragamo in Italy. And the second question, of course, was Ferragamo France a fully fledged distributor? I suspect that that's the way that Ferragamo presented it, and that's why they said, we're comfortable with the losses because this is a fully fledged entrepreneur and it will make profits in future. And obviously for the tax authorities, the short-term view of no, this is a limited risk distributor and therefore it should make profits every year was the more attractive view. But we don't hear much about this in these two cases. And then the referring court says also the administration established that Ferragamo France participates in the development, we already saw that, and enhancement of the brand by incurring external salary expenses that an independent reseller would not bear. And this criteria to me sounds a lot like Maruti Suzuki, right? In Maruti Suzuki in India, they said, let's look at the Indian manufacturer and distributor, and does it pay more in marketing or PMR expenses, right? Advertising, marketing, and promotion. Does it pay more than what its competitors does? And then that extra part should be charged to Suzuki in Japan. And here you see something similar. Ferragamo France was paying more, and it was marketing for helping Ferragamo SPA's brand to be expanded. What I find interesting is there's little discussion of whether Ferragamo France was building any local intangibles which it owned, and for which Ferragamo's power would not have to compensate it directly, right? And then the court, and here basically the Ferragamo lost the case already. The court looks at a number of other points further. It looks at comparables, and it says, first, Ferragamo France maintains that the undertakings selected in the panel, and I mean the comparables mentioned above, were not comparable since they essentially carry out their activity in the provinces, while its activity is concentrated in international tourism area, mainly Paris. Their workforce is less than 10 employees, while Ferragamo France employs 68 employees. They were mere distributors, whereas it also carries out an activity of managing a network of shops and concessions in department stores, and that some of them own their premises while it rents its premises, while Ferragamo France rents its premises for a much higher amount. First of all, I think Ferragamo shoots itself in the foot because it underlines its flagship store idea and where and why it should be earning more. And secondly, if you're going to say you also carry out activities of managing a network of shops and concessions in department stores, that's yet another function that is performed that should also be compensated by itself. I'm not sure I would have come with that argument, but in any case, Ferragamo does, and their head of tax is someone who's highly competent, so they definitely had their own reasons for doing so. And the court then goes on and says, however, most of the comparables were proposed by Ferragamo France itself, so you can't complain about the comparables because those were the ones you used, right? Moreover, it does not indicate that the correction should be made. So Ferragamo says there should be correction, but doesn't say what. And then moreover, Ferragamo does not claim that the exclusion of the companies in question from the calculation would lead to a reduction in the same amount. So that's a bit of a silly argument, I think, of the court, because obviously Ferragamo would not have argued this if it didn't help it. And then finally it says, as regard the insufficient consideration of an activity of managing a network of boutiques and concessions in department stores, the point that we just looked at, Ferragamo does not adduce any specific evidence in support of its allegations. And of course, that is another problem, because if you claim something in court, you must be able to prove it. And then the court goes on to say, in the third argument, Ferragamo France submits that the administration had to take account of the realization in 2005 of a profit resulting from the sale of a shop located on Boulevard de Saint-Honoré, I think it was, in the amount of 10 million euros, which it considered should be set off against the amounts of the corrections. That amount constituted a capital gain from the sales of a tangible asset of Ferragamo France and not an element of turnover. So the court says you can't use the sale of this previous shop to say, oh, but you know what, actually our profit margins were not that bad. And I think that it's a fair argument, because normally you look at turnover and you exclude extraordinary events, right? The capital gain at issue cannot be regarded as an indirect subsidy by Salvatore Ferragamo SpA for the benefit of the subsidiary, or as an advantage granted by the parent company justifying consideration for the lack of a remuneration allocated by the group to Ferragamo France for doing all these enhancement and development functions of the Ferragamo brand in France. Again, it is almost an L&G type of argument, saying, you know, each transaction must be compensated at arm's length and you can't just lump them all together. I think that it brings up an interesting point. I mean, the first one would be who owned the shop that was sold. One would assume that if the profit went to Ferragamo France, then it also owned the shop, and therefore one would wonder why Ferragamo SpA would be entitled to any part of that profit. And then the other point is, you know, the Ferragamo tried to argue, well, there was a certain brand-related goodwill attached to the store, which triggers the question, well, what came after Ferragamo? Was it another luxury brand fashion store, or was it a bookshop, which would have no use for the Ferragamo store being there before? And it brings up the interesting question of whether a brand can stick to realty. I would argue that would rarely be the case, but again, I've not looked at the underlying first decisions of the French court, so maybe there would be something in there that would support this argument from Ferragamo. And then finally, it says in the fourth place, Ferragamo France submits that by using the transactional method of net margin, the adjustments from the tax authorities were outside the arm's length interval. However, the court says that TNMM is not one used by Ferragamo France to initially expose its transfer prices. The calculations made by the company include a reclassification into an operating element of capital gain. So first of all, we used the resale price, and then you went and included a capital gain in there. So that's not good, which is not an element of the result of calculating the operating margin achieved. So basically, the court says, you know what, you can't complain about this being the wrong method. And the court then comes to a decision. It says, first of all, the judgment of the Administrative Court of Paris must be annulled, and then it says all the additional corporate tax and withholding taxes and additional taxes and interest must be reinstated. So Ferragamo lost this case. I think it is an interesting case. In the extent that it talks about, you know, the additional brand building that Ferragamo France did and for which it was not compensated. And I look forward to talking with you further next time in the next case. Any comments and suggestions about this case, please put them below. I'd love to read them. Bye for now.